All right, let's talk about trading when volatility is low. We've talked about trading when volatility is high, either after a decline and then an advance, or when you think volatility is going to enter the market and there's a big decline coming. But what about circumstances when volatility is low? Well, that's really the easiest trading of all. And how do we know when volatility is low? Remember, from the very first videos, we talked about the range. The range of the bar is absolutely the most crucial aspect of determining volatility. And so in March of 2009, after the market had dropped close to 45%, and we're down about 6,500 on the Dow, based on technical analysis that I did at the time, I was calling for the market to rally from that point to 10,500 or higher. But the point was that we were looking for signs of decreasing volatility. And actually that ended up happening on the decline. I kept an eye on the market as the market started to decline into the 6,500 level. And I noticed something interesting. Number one was the bars were quite wide going into the financial crisis. The bars were extremely wide. Moves of 200, 300, 400 points were common. And then all of a sudden we started going into a slow, rather calm decline. A couple of very large bars in here, but as we started to decline even further, I noticed that the declining bars started to get smaller. Here's a nice small one. Here's a little bit of a small one. Here's a very, very small one. And then here's a small one. And then here's a small one. And all of a sudden we had a very large bar up. Well, that small decline on this particular day gave me an indication that, well, maybe volatility is starting to decline here because the wide-ranging bars were gone. Smaller wide-range bars were starting to come into the market, and so volatility was starting to decline significantly. Now, I didn't jump into the market and go long at that point. I waited for a bit of an advance, and then I took a look at the bars on the declining phase. The declining bars, the red bars that started coming into the market were relatively small, and they were quickly followed by an advancing bar. So towards the end of the month, I started looking at these the change in the market. All of a sudden, we started getting small ranging bars to the downside, wide ranging bars to the upside, and that gave me an indication that volatility was starting to decline. As we went through the beginning of April, you can see that the decline of the red bars, which showed declining days on the market, were really quite small, and they never went below the previous lowest low. So we were constantly getting higher highs and higher lows at the same time, which is the definition of an uptrend. As things continued through mid-April, now things got really interesting because right in this area right here, you can see that there was a real interesting dynamic going on. Let me just move this up so you can see it a little bit better. But right in this area here, all of a sudden we had a big large bar, but that was it. There was no follow-through whatsoever, and smaller bars started coming into the market. This cluster, 1, 2, 3, 4, 5, 6 bars right here showed that the volatility was starting to decline and the market started to ramp higher. At that point, I became very interested in going long. And the easiest way to do that after volatility has decreased. Now, from this point forward, volatility in this time period was about close to 50%. At the height of the financial crisis, it was over 100%. And as the market started coming down into even lower levels in the previous all these wide-ranging bars here, volatility started coming down to the 50%. By the time it was up here in the middle of April, volatility was starting to come down into the 30s, in the 40s, 30s and the low 40s. And at that point, I started getting interested in going long. That type of volatility is not terribly high. I think anything over 30 is pretty high. But right around 30, 35, I would be interested, and I would simply purchase a long call. And that's all you really have to do. Purchase a long call. Now, here's the secret to making money as the market advances. It's adding and leveraging your position. Normally what happens is when you get into a position for the very first time, you want to start out with a low number of contracts. So if you're purchasing options, you want to buy a low number of contracts. So if you have a small account, buy one contract on a call. So you can buy it on the diamonds. Let's take a look at the diamonds, or you can buy it on the SPY. Stick with the liquid high volume trading ETFs. That's my advice. There's all kinds of strategies you can use for individual stocks, and if you're a great stock picker and you can go out there and look for stocks, fantastic. I wish you the best.